Hey, Brad Bob here, and today I've got an interesting subject to cover, and that is the three worst financial products, or at least the three worst financial products in my mind. And in this, for me, it's not necessarily the three worst products because each of these products you could make a case for in somebody's situation, but to me, it's more so sales practices of the people that sell these products or the agents that sell these products. Okay, um, I don't like the way they're sold. Just it can be very deceiving. All right, but let's go through them. All right, have a little fun. So number three for me are variable annuities. Okay, so this is an annuity sold by agents. You actually have to have a securities license to sell these products, and they can have excess fees. All right, they can have really high fees. Variable annuities typically have a mortality and expense ratio, which is normally 1.25 to 1.5, something like that. Then you can add riders to these annuities, and riders like a living benefits rider, a death benefit rider, and they can cost somewhere around 1%. But you can't, it's not necessarily one. You can add one, you can add a second, you can have multiple riders on these. And then within the variable annuity contract, you pick your sub accounts. And these sub accounts are like mutual funds. So it's common to see variable annuities with total expense ratios of somewhere around 3 to 4% and even higher. All right. I've seen ones that have total overall expense ratios north of 4%. That's crazy. Okay. Tell me how you can ever make money if you're paying expenses of 4% annually. And then how they work, okay? You've got, they're confusing how they work. Like you can have a living benefits rider on it, and it has an expense ratio of, say, it has an expense of 1%, all right? And let's say your account balance is $100,000, but then you have this kind of fictitious income value that may be $150,000. Well, that 1% is calculated off the $150,000, but yet it's deducted from the account balance of $100,000. Okay, and I'm getting into a number of details here, but another thing is they have surrender charges. All right, now there are some what I would call low cost variable annuities available now. They're getting to be more common, which is a good thing. But in the past, or even still today, most of them have surrender charges, which typically range from 4 years to 7 years. All right. And one issue with these surrender charges is the agents that sell these annuities, a lot of times, as soon as the annuity gets out of surrender charge, okay, 4 years is up or 7 years is up, guess what? They find a reason to get you out of that annuity and back into another annuity. They get paid a new commission. Now you've got a new 4 year, 7 year surrender charge. Another thing that people can do with these is they may add a management fee. They may charge a 1% management fee tacked on to all the expenses you have. Okay. So expenses for variable annuities can be crazy. All right. And I just saw something today or yesterday that reminded me about variable annuities. There was a company called themselves Federal Benefits Advisors, Federal something advisors. And what they did is they preyed on people, federal employees. They got people to move money out of their TSP into their variable annuities, and they got in trouble for their deceptive sales practices. Not a coincidence. So that's number three, variable annuities. All right, number two is whole life insurance. Okay, and again, whole life insurance is a product that I think can work in it can have a purpose for, in my opinion, it's a smaller percentage of the population, But yet you've got agents selling whole life insurance, and you've got companies that incentivize their employees, their agents, to sell whole life insurance. So they are pushing that. They're trying to sell that to everybody. Okay, and it's just not a fit for everybody. It's not. And I've been one of these agents that work for a company that's what they want you to sell is whole life insurance to everybody. Oh, you're 18? Well, there's a reason for whole life insurance. You need some. Oh, you're 25. You just started a family. You have a low income. You know what? You're young. You need to start whole life insurance now. Whole life insurance it's not cheap, okay, and it's not very flexible. And the agents will argue that it is really flexible. They'll argue that you get paid a lot of money with whole life insurance. They'll say, oh, your money's going to make 8%, while you also are leveraging your money to get this death benefit. I've never seen a whole life policy that has an internal rate of return of 8%. In fact, I've never seen a whole life policy perform the way that the company's illustration has said it would perform. Okay, everyone that I've seen has performed lower than what the initial illustration has shown. So another thing, I mean, there's all kinds of things here. The cash value. So cash value is the money you get out of this policy that you can actually use while you're alive versus the death benefit. And typically in these whole life insurance policies, it takes around 10 years or so. And I'm generalizing here. I've seen a number of them, a number of different companies sell them. It generally takes around 10 years to get all the money that you have paid into the policy in it. Okay, so in other words, you're not making any money until the 11th year. All right, that's a long time. And the first year you're putting money into it, and you get your cash value typically at the end of the first year is zero because they paid all that money out in commissions. All right, it is a product that pays the agents to sell it very well, as are variable annuities. Okay, number one. What is number one? Number one, if you follow me very long at all, you probably know what number one is. And that is indexed annuities. Okay, these come straight from the devil. Okay, pretty sure that he invented them. Indexed annuities, again, now this is something, even when I could sell these products, I still never sold one. I tried, I talked to many people, I had them try, I said, please convince me, because I would love to get paid at 10% commission or better, or whatever the commissions were at that time. But I was never convinced it was the best thing for my clients. But I have seen some, again, that could be a fit for a very small select people. But it's just people I work with, it typically is not, okay? Federal employees, all right? You guys are my niche. That is who I work with, and it is rarely ever a good fit for federal employees to do this, okay? Index annuities typically do not make much, all right? And they use such deceptive sales practices to sell these index annuities, and they'll tell you the pros of them, the benefits of an index annuity, but yet you don't hear the downsides. Pros of them, like, hey, market goes up, you make money, okay? Market goes up, you make money, and market goes down, you don't make money, okay? You stay even. Well, there's more to it. You can have expenses to it, to where if the market goes down, you actually lose money because of the expenses. Typically, you have caps to where you can make, for example, you can make only 4% a year. That's kind of crazy. You can only make 4% a year, but then you put your money in here and you've got a 10-year surrender charge. Or there's ones where you have a 20-year surrender charge. These can get crazy when it comes to surrender charges. It works out well for the agent. The agent's selling them because they sell it. They get paid a big commission. Boom, they're done. Moving on to the next the next victim, or whatever, the next person, whatever you want to call And I've heard, I've had people sell me on, well, this index annuity performed great over the past year or the last 2 years. And again, it tends to be deceptive. They may have like 25 different crediting strategies, and this one crediting strategy did really well over the past year. So if you were lucky enough to pick that one best crediting strategy, boom, made all kinds of money. And to me, that's like timing the market. Okay, that's crazy. You've got 25 different crediting strategies, and you're saying this one did great, where the rest of them didn't do well. Okay, well, if that's the case, then maybe you can tell me when the market's going to go down again, and then tell me when it hits a bottom, and then tell me when it hits a top, so we can get out, we can buy. Come on, man. Crazy stuff. So index annuities, and this is the one, to me, and from what I've seen, this is the one that is sold the most to federal employees. Trying to get federal employees to take money out of their TSP, put it all in a product that guarantees you a rate of return. Actually, doesn't even guarantee a rate of return, does it? It's conservative, okay? It guarantees you won't lose money, minus the expenses. It's just, there's so many ifs, ands, buts to these products. From my experience, what I have seen, if you're thinking about moving money from TSP to an index annuity, you'd be better off just leaving money in the G fund, okay? The G fund is as safe as it gets. If interest rates go up, the money you make on the G fund is going to go up. And you've got flexibility. And now, while I think an IRA is typically more flexible than TSP, there's some exceptions to that, like prior to 59.5. Or if you're going to have an IRA that's in an annuity, you're going to compare that flexibility to leaving money in TSP in the G fund. G fund TSP is way more flexible. Okay? So now I could go on talking about these three products all day long. My opinion, especially working with federal employees, these are the three worst financial products, or at least the three most, the three products that use the sleaziest sales tactics. Sleaziest sales tactics. Say that fast. 3 products that use the sleaziest sales tactics to sell products to federal employees, to get you guys to give them money so that they can make a lot of money. So, again, not that these 3 are bad alone, just using that product, if it's part of a financial plan, if it is, say, a small percentage, I shouldn't say very small, but a small percentage of your liquid net worth. You should never take all the money in your TSP or, say all of your investable assets and put it into one product, okay? And I'm not referring to mutual funds. You can have a very well diversified mutual fund or ETF or index, something like that. I'm talking about a product such as an index annuity, variable annuity, whole life insurance. You move money into it. Now it's very restrictive for getting your money out. You've got surrender charges, stuff like that. So hopefully that helps. Do your own due diligence. Do some research before diving into one of these products. Thanks.